Okay, let's go, guys. Good afternoon, ladies and gentlemen, and welcome to our session, which is the Budget 2024 Key Impacts and the Strategic Analysis. In this session, we will cover the provisions that have been announced by the Finance Minister relating to the key direct as well as the indirect tax issues and assess the implications of those. In addition to this, we'll also do a bit of talk on the policy changes that were announced during the budget. But before we go there, I'd like to take a minute to talk about us. So ASA has been in practice for 33 years. And now we are a team of well over 1,000 people across 8 cities in India. We deal with extensively with, actually, I would say, with domestic and international businesses, finding partners, doing their M&A, JVs, setups, advise them on tax issues, accounting issues, and many other business support requirements. Of late, we've also started doing a fair amount work with the ESGs, uh, risk, and exploring many other avenues on restructuring, liquidation, etc. Coming to the budget, this budget, like every year, is always an interesting exercise that comes our way, especially as chartered accountants, where there is a lot that the government does in terms of defining and redefining of various provisions of the law related to indirect tax, direct tax, exchange control, labor laws, and so on and so forth. I mean, let me tell you, it is a nightmare for us also to understand and interpret those issues. It takes a while before we also start getting clarification. And for people who do not come from the financial fraternity, it could be an extremely difficult exercise. And that is precisely why we do these sessions, because we try and break down those intricate provisions to a simpler version and try and put uh, our interpretation, our understanding, whatever name, because still there are a lot of areas that are gray, and we are ourselves struggling to find out, what the budget had to say. But I have 5 minutes, because the speaker just before the session started told me that there is so much to be talked about that we have to shrink your part to the least possible, and therefore I'm going to tell you my story in the next 2 minutes, and then I'll move on to the speakers for them to explain the intricacies that have come in. The good part of this budget, let me say that first, because there was a fair amount of good. I would say that one of the things that this government has always impressed upon is the fiscal prudence. And even this year, the finance minister went on record to say that the fiscal deficit for 24-25 will be restricted to a number less than 5%, 4.9 to be more specific. And over the years, they plan to bring it down. Now, that is clearly a message that we send out to the international community, clearly saying that India is doing well on the fiscal side. The second part, and which is something I've been talking in my earlier sessions also, is the government's initiation on the upskilling and the reskilling. The government has at least made us start realizing that there is a problem here, and they have made some basic steps. Now, some people are criticizing that, saying this is not good enough. Some people are saying they're good. It's a mixed bag. I personally feel the start is the most important thing, and once you start, you kind of develop it into making it more effective and useful. So that was very important, because people are there, but employable people are the ones which were missing. So that was a good step. A lot of irritants have been taken off. The equalization levy, the angel tax, the safe harbors have been extended further to reduce the potential. Foreign companies have been, given a reduction in their rate of taxes. Long-term capital gain, well, that's a mixed bag. Some people find it very interesting, the others don't. Each analysis that I read gives me a more confusing statement as to what is going to be better. The middle class has been given some sops, 75,000 on standard deduction. So all in all, this is what a budget is supposed to do. I mean, the government, and I maintain this again and again, has got limitations on what they can do. So they've given some, they can take away some, but overall, the idea is to grow the taxes and maintain the fiscal, prudence that they're talked about. I'm not going to get into any other detail because we have two panelists after this who are going to extensively talk about the taxes, both on the direct and the indirect tax impact. And then we also have a panelist who will talk about the policy changes. So I have consumed my time. I will immediately pass on the mic to the next person, which is Sunil, my colleague who heads our direct tax vertical. Over to you, Sunil. All the attendees, just as an additional information, are going to be in the listen-only mode. If there are any questions, you can put it in the Q&A section, and we'll be happy to answer it at the end of the session. Over to you, Sunil.
Thank you, Rajiv. Thank you. A very warm welcome to all of you, and a very good afternoon. I think on the direct tax part, Rajiv has already set the context, the tone for this budget. I think from where we see it, there has been a lot of honest effort to sort of sort out a lot of issues that were giving trouble. Rajiv already mentioned some angel tax, things like that have already been taken care of. So how does this budget look like? Obviously, like every year, direct tax has been the main agenda that has been discussed. And obviously, there are some provisions on the indirect tax too. On the direct tax side, we have about 64 main proposals. Now, these proposals have been sort of identified into different sections. That's how the budget is generally written. And if you look at the fine print, if you break it down, there are more than 110 changes that you find in different clauses. If you further break it down, the changes are even more. So I think if you were to do a bare reading of the Finance Bill 2024, the changes will be easily close to 130, 140, 150 changes. So that's the state of the budget. Next slide, please. So what are we going to cover today? We have limited time. Obviously, it's very difficult to cover. As Rajiv said, there are various views coming. It's a lot of gray areas in some provisions. So we decided to cover some very interesting areas. I have about 9 sections that I wanted to cover, but I'm sure in the interest of time, it may be still difficult to cover all these 9 sections. So I will try and at least cover the main parts, issues on angel tax, issues on capital gains. Let's try and cover that in a big way. So I think again, just to sort of set a context to what we're going to discuss, there is a lot of positivity in the budget in the sense that a lot of nuisance has been taken away. Angel tax, for one, has been taken away. Equalization levy has been taken away. Now, everything has a background and there is a reason behind it. But let's try and understand what were the key and major steps. Even the next slide, please. As far as the tax rates are concerned, I think individuals HUF, it's a very well-written subject already. As far as the old regime is concerned, there is no change at all. If you see the table below, you will find there is no change at all. New regime, there is a change. These slabs have been relaxed a bit. They've been given more bandwidth in terms of the fact that you now get extra tax relief up to 17,500 rupees. Now, if you pay close attention to how government is sort of trying to sell the new regime to the public at large, when the new regime came, it was more complex. But again, the focus was to sort of get you into it. Last year, there were 7 slabs. 7 slabs were turned into 6. This year, these 6 slabs have been relaxed, and therefore today you see a shape of the new regime of tax rates, which is even more beneficial to you. Now, if you look at it in terms of employment, as Rajiv mentioned, standard deduction has been increased by 25,000 rupees. And a basic analysis says that if you're a salaried employee and your salary is up to 7,75,000 rupees, you eventually end up paying no tax. What has been allowed extra additionally is that if you are an employer, you can now allow any tax that has been collected or paid by an employee by way of TCS. TDS was already allowed. If you are paid a TCS, that is also a part of the adjustment that you can do in computing the salary TDS. Now, the way this is building up, and we've been reading a lot in the press, we've been hearing the revenue secretary, the finance secretary, the finance minister herself on the budget. It is all the more becoming clearer that that the new regime is going to prevail. The old regime may be phased out in a year or two. I think it's a good thing to happen also from an administrative purposes, from a clarity perspective also, if you're a taxpayer, for you to understand what regime applies to you and not sort of forget about and completely forget about what's the default regime and what's the optional regime. It's a good thing to happen to us. The next slide, please. About companies, I think all of us again have read this also very closely. What is the biggest miss here? The biggest miss is that the 15% rate applicable to new manufacturing companies and cooperative societies, that was a highlight for the Make in India campaign. Now that, unfortunately, the timelines have not been extended, which means any new companies now cannot join the bandwagon of the 15% concessional rate. However, it still remains applicable to the companies that already have this rate. So if you are one of those companies that have a 15% concessional rate, you continue to get that. But if you're a new company wanting to get into the 15% rate, that's not available to you. All the other three rates, 22%, 25%, 30%, operate the way they used to operate. What is the biggest hit as far as company tax rates are concerned, Rajiv also mentioned, is the fact that the foreign company rates, these are essentially the permanent establishments in India, branch offices, project offices, any sort of permanent establishment, the 40% rate applicable to them, the headline rate of 40%, has been reduced to 35%. Now, this obviously is a huge, huge relief in terms of what you see as tax arbitrage with the domestic companies. If you look at just the high-level impact, we are talking about a reduction of about 5.5% in terms of the tax relief that you get. As far as partnership firms are concerned, local authorities are concerned, cooperative societies, no changes at all as far as they are concerned on the rates. Next slide, please. Angel tax, I think the most talked about subject. I think the number of articles that I've read on angel tax, obviously, there is no more desire to read about this subject anymore. It's already too much. Now, what is angel tax? Angel tax obviously refers to the tax on contributions made by angel investors. Who are angel investors? Angel investors are primary initial investors into any project. Now, startups, if you remember, this tax came into being in, I think, 2012. And since then, we have been dealing with a lot in terms of the disputes that have risen on angel tax. What it essentially says, angel tax, it says that if there is a capital contribution into a company and the capital contribution exceeds the fair market value of the instrument that you're investing in, which is essentially the share capital, fresh share capital that the company issues, this excess will be taxed in the hands of the recipient company. And this applied to unlisted company. Obviously, the concern then was that a lot of money laundering, the government was observing that there was less transparency in terms of unlisted companies, the way they were being managed. Obviously, there was an anti-evasion provision to check these money laundering activities. But then it led to consequences that were completely unwarranted at that particular stage. And a lot of startups actually started facing a lot of trouble in terms of attracting genuine capital from a lot of investors. Now, I think off late, what has happened is that there is a lot of transparency that we have seen in tax reporting. Now, under Section 68, you are required to report your investments into unlisted company when you file your tax return. Again, you also have share demat requirements now, very clear share demat requirements. Now, all of this put together, brings a lot of transparency into the system the way the unlisted companies are managed and the way investors participate in unlisted company. So the government decided to sort of call it off and completely call it off, and so therefore this stands withdrawn. Now the important part here is to understand that this withdrawal is not retrospective. So any disputes that you have right now as regards any part and parcel of angel tax regulations, they're going to stay. You're going to have to fight them, challenge them on merits, and come out victorious. But there is no change to that. Another important change on ease of investment side is the withdrawal of equalization levy. As you all know, India has been a very active participant in the Pillar 1, Pillar 2 discussion under the BEPS regime. Now, obviously, when this 2% EQL was levied on cloud services, e-commerce services, it has a very wide coverage, by the way. Any SaaS platform, any data service platform, cloud, financial services, edge services, digital sales, anything that you do attracts a 2% tax. Now, this 2% tax also does not qualify to be in the definition of tax as far as the Indian income taxes is concerned. So the investors, foreign companies who were paying this 2% tax, they were also finding it difficult to claim a credit of this tax because this is not defined as tax. This was levied by way of Finance Act and not by way of the Income Tax Act 1961. So this was a big issue amongst foreign investors, and thankfully this has been taken away. What happens after this? We don't know. Maybe the SEP provisions will kick in, but we don't know right now. There is yet to be more clarification here. One point that you must note is that only the 2% EQL has been withdrawn. The 6% EQL on online advertising still says there is no change there. There is a benefit, again, a benefit given to non-resident cruise operators. Again, significant from the perspective that it's a new entry option, new window that is being provided to non-resident shipping companies, cruise operators, but nothing earth-shattering about it, so we can move forward. Venture capital funds, regulated entities, they've been facing some trouble. They've been asked questions like, the money that you lend into different companies, prove us the source of this money that comes to you. Now, the government has very clearly said that, these are regulated companies and they don't need to sort of, establish any source of funds. They're already regulated. They're regulated by SEBI, and therefore there is no need for them to prove their bona fide in terms of the investments that they make. Next slide, please. Capital gains, again, the much talked about subject. I'm going to try and break it down for you. And again, the key elements, there are a lot of gray areas still sitting in the fine print. But what are the main areas? Now, there were multiple holding periods, as we understand on the capital gains side, to multiple criteria, time periods to define whether an investment asset is long-term or short-term. Now, what they've done is they've broken it down into two sections, actually three, but on the face of it, true. So listed securities, any listed security, if you hold it for more than 12 months, it results into a long-term capital gain for you, a long-term capital gain. It's a long-term transaction or a loss. All other assets, including unlisted securities, your gold, your immovable properties, anything else, has to be held for 24 months for it to be called and qualify as a long-term asset. Now, there is a fine print in the budget that also clearly says that as far as slump sale holding period is concerned, that remains unchanged at still 36 months. Now, that is not being talked about much, but if you see the fine print, that very clearly means and says that the 36-month period still says as far as slump sale transaction holding period in a slump sale transaction is concerned. So that's there. Tax rates have been defined, rationalized. Now, a lot of people, as I said, Rajiv also said, by the way, there is a mixed response to how this has been seen. Long-term gains rate slightly enhanced from 10%, existing 10% to 12.5%, short-term from 15 to 20, and there is an impact on futures and options. Now, I think the biggest point of discussion that has been, and this is the, again, maximum number of feedback that we've gotten, is the withdrawal of indexation benefit. Now, how it impacts you is anybody's calculation, and there could be various parameters to sort of measure that. But as we stand today, there is no inflation-related indexation that you're going to get. The only saving grace here is, and that again is something not mentioned in the finance bill. This has been clarified in the press conference after the post-budget press conference, is that if you have had an immovable property that was acquired or inherited prior to 1st of April 2001, there will be grandfathering in terms of inflation, because the legislation relating to indexation changed on 1st April 2001, and therefore there is some protection to these properties that were acquired earlier. And then there is a basic exemption that has been increased from 1 lakh to 1.25 lakhs. Next slide, please. Another big area of concern. Now, this is about how we tax buybacks today. How we tax buyback of shares today is, buyback of share happens, for those who are not aware of this concept, is when the shareholders are able to sell the shares of the company back to the company. So it's a very popular way of remunerating the shareholders. If I clearly remember, I think TCS did a very large set of buybacks in the recent past. And I was reading a report which said that in the last 1 or 2 years, there have been 48 big buyback transactions happened that have resulted into I think a transaction value of 48,000 crores. So it's a big issue. Now, how buybacks are taxed today is under the existing regimes. Today, if there is a buyback, the company that is doing the buyback pays tax, and the tax rate today is more than 20%. So the company pays tax. Now, when the company pays tax, what essentially happens is that since the company is paying tax, the impact of this tax paid by the company spreads across all the shareholders, and not just those shareholders who have opted for buyback. And that was the anomaly they were trying to correct, and they've corrected it in their own way. Now, what is the new buyback tax regime? The tax burden, what they've done is, now the company that is doing the buyback is not going to pay tax. The shareholders that have opted for buyback are going to pay tax, like we pay tax on dividends. And they've drawn a very clear comparison between dividends. They've said both of these result into returning cash to shareholders, because this is shareholders' money going back to specific shareholders, and therefore they should be taxed in a similar manner. And they've said now any money that you get on buybacks is called deemed dividend for technical purposes. One of the questions could be, since this is deemed dividend and the shareholders are receiving dividend, would this be eligible to let's say tax benefits under the tax treaties? Maybe yes. I think subject to the treaty conditions, maybe the answer could be yes. But let's see. There is yet to be more discussions happening on this issue. So how is it going to operate? What they've said is, at the first stage, you tax the entire consideration. So let's say the buyback happens at a consideration of 100. Company pays the shareholders 100. You forget what was your cost of acquisition. You forget any other cost. You're going to tax this 100 and tax it on rates that apply to you, applicable. If you are taxed in the 20% bracket, you're going to pay 20%. If you're taxed in the 30% bracket, you're going to pay 30%. So tax it on normal rates applicable to you, the entire consideration. As far as the cost of acquisition is concerned, obviously there has to be some treatment given to cost of acquisition. What they're saying this cost of acquisition, treat it as a capital loss. Don't deduct it from anywhere right now. Use it as a capital loss, and this capital loss can be set off in the current year or in the future years, depending upon the rules and regulations that apply to the set off and carry forward of losses. Now, interestingly, this scheme applies to buyback of listed and unlisted shares, any transaction happening after the 1st of October 2024. Again, there are many questions, but again, I think this is a subject that is going to be discussed for a long time. Next slide, please. Another interesting aspect of this budget is the resurgent or a reintroduction of a tax settlement scheme. This is called the Vivad Se Vishwas scheme. A similar scheme was introduced in 2020, and we've done a small comparison on the scheme that was done in 2020. I'll move on to that. But what they've done now is they've said any cases that are pending as on 22nd of July 2024, the day before the budget was announced, are eligible for settlement. Any appeals that are pending. Now, these appeals could be before dispute resolution panel, commissioner appeals, tribunals, High Court, Supreme Court, any appeals that are pending can be settled under this new scheme. What is the charm of this scheme? What is the basic giveaway of this scheme? The basic giveaway is there is full waiver of interest and penalties. That could be a lot in some cases. That could really be a lot in some cases. Now, what are the criteria? The criteria obviously are linked to the appeal amount, the quantum, the period of pendency of the appeal, and the date of settlement that you choose. So we've given you by way of a flowchart. So they've started. They've said they've categorized the appeals into two parts. One that is prior to 31st of January 2020, which was the cutoff date for the last VSVS scheme, and the other is post. And you can see the percentages. It's very straightforward. Basically, what they're saying is as long as you pay at least 100% of tax due, we are happy to settle your case. We don't want interest and penalties. And this offer expires on 31st of December 2024. Beyond 31st of December 2024, we are going to add this amount. We are going to charge you a little bit of extra amount. So 100 becomes 110, 110 becomes 120, 30 becomes 35, 25 becomes 30. Now, we've done a brief comparison of the scheme of 2020 and 2024. Now, in 2020, just for your reference, the scheme, overall scheme ran for about 18 months. So, although they have not given an end date to this scheme, let's say we were to apply the earlier norms, this could ideally run until the end of 2025 on a high-level basis. In the earlier scheme, if there was a case where the time limit to file an appeal had not expired, you could still go under the settlement. In this scheme, you cannot. In this scheme, you have to have a pending appeal to be going under the settlement scheme. One basic difference was that matters less than 5 crores of demand, where the tax demand was less than 5 crores, matters that resulted out of a search and seizure did qualify to be settled. In this new scheme, they are not being considered. Last scheme was a huge success. Over 1.13 crore cases were settled, 76,000 crores of revenue collected. Let's see what happens to this scheme. We've been talking to a lot of investors, a lot of foreign companies, a lot of our clients there. I think they would be taking this offer hands-on. It's a good offer from a settlement perspective. Next slide, please. Some changes to the tax withholding, tax collection norms. Again, the government has given effect to a lot of demand from the industry, industry chambers. One main change that has happened, more or less the rates have gone down. And by the way, the government is very keen, and you might see it happening in the next budget. They're very keen to streamline the tax withholding rates. Today, the rates range between 0.1% to 30%. If you're a foreign company, maybe 35%. And the government is wanting to streamline all these rates. So you may see more of these things happening going further. The thing to note here is the change in tax withholding rate that applies when there is a payment by an e-commerce operator. This could be a resident or a non-resident e-commerce operator to a resident e-commerce participant. Now, these are suppliers, these are vendors here, participants here. They are sometimes very small companies. Sometimes they are playing on volumes and incurring huge losses. So a 1% tax was already eating up into a lot of cash flows. There is a significant reduction of 99% in this rate. So 1% becomes 0.1%, 90%, and that's a huge relief. I think other than that, there is not much to be discussed on the tax withholding side. Next slide, please. Assessment appeal proceedings, again, a very welcome move. And the biggest move that has happened, this was also in the speech of the finance minister, is that the 10-year window to reassess any case in the highest slab, the 10-year window has been brought down to half, to 5 years, which is a very, very welcome move. Similarly, for search cases, the 10 years have become 6 years. But as far as reassessment is concerned, 10 years going down to 5 years is a very, very welcome move. some other dates have also been streamlined, as you see below. I think the biggest impact that you see here is it brings a lot of certainty because there is a definite time period which is foreseeable. 10 years is a very long time. So I think all the M&A deals that were happening will have a much relaxed indemnity clause because the 10-year suddenly becomes 5 years. And therefore, there is far more certainty in the way we discuss deals today and settlement of matters. Next slide, please. As far as reporting requirements are concerned, I think just one or two critical aspects, and I think this may be critical on various fronts to various taxpayers. Now, there is a requirement to obtain an income tax clearance certificates when an individual departs from India. When there is a final departure, you go to the tax officer, you submit documents to satisfy him that you have made all arrangements to pay any past, present, or future taxes. And on this basis, this assurance, you are given a tax clearance certificate, which may or may not be required at the time of departure. The immigration officer might ask for it, but this is a good way to say goodbye to India, tata to India. Now, what they've said is, given that there have been a lot of liabilities, past liabilities emerging under the Black Money Act, there is a specific requirement now for you to assure the tax officer while you are obtaining the income tax clearance certificate that, look, I've made arrangements to pay my tax under all other legislations, including the Black Money Act, and therefore, if there is any liability that comes to my name, which is past, present, or future, I'm going to be responsible for it, and I will make arrangements to pay that. That's one big change because now when you depart from India, there has to be a very conscious analysis on the declarations in the past that you have made that may or may not be a subject matter of Black Money Act. So please be very clear when you submit any declaration before the tax officer, because incorrect declarations again are not in your interest. One more change, a bit of a welcome change, is that in the tax returns, in the foreign assets section of the tax returns, you are supposed to declare any foreign assets that you have. And of late, there have been instances where people having small amount of assets, movable assets, let's say ESOPs or any other financial assets, they have failed to disclose that, simply thinking that the amounts don't add up. They're very small amounts and it may not be relevant. However, the penalties for not disclosing those amounts were very, very high, were 10 lakhs, almost ₹1 million. So what they've done now is they've said, as long as the asset that you failed to disclose is more than 20 lakhs, we are not going to charge you that penalty. So I think that's a very welcome move. $25,000 worth of asset. If you don't disclose it, there is no penalty arising on you. So you save that 10 lakhs. A stricture on liaison offices. You are required to submit an annual activity report in Form 49C. Basically outlines what activity that you've done on a year-to-year basis on the India tax offices. I don't know how many of you are aware, but the activities of the liaison offices are very restricted. And therefore, the income tax department wants to understand what exactly is that you've been doing in India, because the moment you cross, you break the China wall, you cross that line of preparatory and auxiliary activities, you can, and liaison office actually can be treated as a permanent establishment in India. And therefore, the income tax office is very keen to understand what has been your activity in India. Now, liaison offices have not been very particular in filing the activity report with the tax office. This time they've said, look, you must file it in time. And if you don't file it, we're going to charge you a penalty of ₹1,000 a day, maximum to 100,000. This is, they're trying to sort of impose this condition on you. Next slide, please. This is my final slide, and just touching on some announcement that were there in the speech, did not sort of translate into any specific proposals. One, and I think the biggest announcement has been that the entire Income Tax Act is being revamped. The finance minister said in a speech that they're looking at a period of 6 months. And going by that, if all goes well, 6 months could translate into post discussions and public discussions and all could translate into 12 to 14 months. And if all goes well, we could have an entire new income tax act over the next 12 to 18 months. So that looks very promising. Obviously, they're trying to make the act very concise, very lucid, and very simple to understand, which is obviously some challenges with the existing income tax act. Transfer pricing safe harbor rules. They are talking about expanding the scope. Uh, Today, the scope of these safe harbor rules is very restricted, just 4 or 5 segments or industry segments covered, and it is mostly used by GCCs today, the back office services today, ITS companies today. I think the range of cost plus margin that is being charged today is between 17 to 24% under the safe harbor rules, whereas under the APAs it is being closed between 16 to 17%, sometimes 15.5 to 17%. There is a demand from the industry that, Indian GCCs, Indian market has come off the edge, and therefore the margins have to be more mature in the sense that they cannot be more than 14 to 15%. So who knows how it evolves. And I think the last bit is the government is very trying to reduce the number of litigations that are there pending before the courts. So they have enhanced monetary limits, which means that the tax office cannot take now every case to the under appeal if they do not agree with the judgment by the lower appellate body. And therefore, what it's essentially going to do is it's going to be lowering the number of cases that are pending before the appellate bodies. So I think given the large framework of what has been proposed in the budget, these are the changes I thought were worth discussing. But very happy to answer any questions when we have the Q&A session on any other proposals that you are willing to know more about. Thank you very much. Over to Sandeep.
Thank you, Sunil. A very good afternoon to everybody. So ever since GST was brought into picture, the importance of indirect taxes in the budget have been restricted to maybe tinkering with the custom duty rates or the procedural changes which the parliament is authorized to do on the GST front. Most of the decisions are taken by the GST Council, and then subsequently the government issues notifications. A lot of them have been done in the last week of June and early July, which are extremely impactful. But today we would be discussing the significant changes made by the budget of 2024 on the GST side and the customs side. So first and foremost, what the government has done is in line with the recommendations of the GST Council, they have announced the amnesty scheme. Now, this amnesty scheme basically covers a restrictive period for all demands up to 31st March 2020 only. And there are certain conditions attached to it. One of them is that any kind of a dispute or a tax demand prior to the period of March 2020, of course, must not be related to any case involving fraud, embezzlement, willful suppression, or that was a particular section under which proceedings were launched, section 74. Any notices under that section would not be covered here. Second is any proceedings up to the commissioner appeal level filed by the taxpayer, those are covered. Anything which has been adjudicated upon by the appellate tax authority, which is the tribunal, those would not be covered here from a taxpayer's perspective. The refund cases where the refund has been given to the taxpayer in excess erroneously, those cases are also specifically excluded from the purview of this amnesty scheme. Now, the conditions are more or less very simple. What the government is trying to say is that if you don't dispute anymore, you withdraw your all pending appeals before the relevant authorities and you pay the tax demand as has been ordered or as is mentioned in the show cause notice or as is mentioned in the statement of demand prior to issuing a show cause notice. If you simply blindly agree to it, deposit that tax demand within a certain period, and that date is yet to be announced by the government, though it could potentially be March 31, 2025. They said if you pay all these taxes as demanded without blinking an eyelid, we will waive off the penalty and the interest, which is part of this tax demand. Of course, it will help a large way where the demands of the earlier years, especially the initial period when GST brought in, and there was enough and more ambiguity into the picture. A lot of litigations are pending. At least there could be savor from a huge amount of interest of these 7 years till now. The benefits would obviously be not only on the interest and penalty, but also that the proceedings would be considered to be dropped, and neither the taxpayer nor the department would have any authority to litigate it further. But there is a catch here. While the demands on the orders raised which are litigated by the assessee can be paid till the appointed date, which could be 31st March 2025. We'll have to wait for the notification. The catch is that if against that particular order on which we have gone under amnesty, the taxpayer has gone under amnesty, if the appeal against that has been filed by the department before a tribunal or before a court of law, either High Court and a Supreme Court, which is still pending for a decision, then in spite of having gone under amnesty, if there is an adverse order by the court of law or by the appellate tribunal, then the incremental demand arising out of that order will need to be paid within 3 months of passing of the order. This is very, very significant because, as normally happens, the government takes all the powers on itself and only gives the short end of the stick to the taxpayers, and that is what has happened. So my suggestion would be that anybody planning to go under amnesty, be very careful. Look at what are the departmental appeals pending and at what is the ramification of that. The other thing they have clarified is that if you have already paid the interest and the penalties earlier, they will not be refunded to you. So which means, in a way, they are saying that if you litigate, wait for us to come out with an amnesty scheme so that we can give you a waiver. Otherwise, if you pay it like an honest taxpayer, suffer for the cost of it. This is broadly the intention of the government, but that is it on the amnesty side. Next slide, please. The other major change which they have done, which is more in terms of simplification and rationalization, there were earlier two provisions under which proceedings could be raised. One was proceedings which considered your tax non-payment as a fraud, intentional evasion, willful misstatement or suppression of facts. That was section 74. And the other was section 73, where it was a normal error and omission kind of a thing, not involving frauds, etc. Now, though the government has said these two sections 73 and 74 will only be applicable till proceedings relatable to financial year 23-24 only, and a new section 74A has been inserted combining these two earlier provisions, and that would be applicable from financial year 24-25 only. So this is now a simplification process. Now, largely the provisions are the same, but because of unification of these two kind of cases, which is fraud cases and simple error cases, certain important things which have to be taken care of would be discussed here. One, the government has said under the new section, if there is any kind of a tax demand less than 1,000 rupees, then it will be ignored and no show cause notice or any proceedings would be raised. A small amount, but nevertheless, minor errors can be. Second thing, they have laid down the provisions of limitation uniformly for both the kinds of cases, fraud and non-fraud cases. Here they have said the show cause notice can be issued within 3.5 years from the due date of furnishing the annual return, which is the GSTR 9. Or in case of excess refund of tax in error by the government themselves, then 3.5 years from the date when the refund has been given to you so erroneously. The order against these kind of notices have now been given a time period of 1 year from the date of issuance of the show cause notice, which can be further extended by a period of 6 months with the commissioner's approval. Earlier, these provisions used to say that there is a time period of 3 years from the annual return due date under which show cause notice can be issued, but the order has to be passed within 3 months before the within 3 months before the completion of the 3-year period, which means show cause notice could essentially be issued till 2 years and 9 months, because order had to be passed within that 3-year period. So this was the condition, and now they have taken some liberty on themselves that they can issue you a show cause notice in the 42nd month, and the order can be issued till the 52nd month from the due date. Extendable period, but nevertheless rationalizes. They have further said that in case for a relevant tax period a show cause notice has been issued, but for another tax period having the same grounds as mentioned in the show cause notice, another show cause notice need not be issued, and a statement can be issued towards the amount of tax which the government feels which has not been deposited or short deposited or wrongly availed and utilized. The condition largely remains the same. Next slide, please. The penalties are more or less the same as per the individual 2 sections earlier. They still continue. So in case of fraud cases, it is the amount of tax due which will be levied as penalty. And in case of normal cases, it is 10,000 or 10% of the tax due, whichever is higher. But what they have said for the penal provisions of levying of penalty, they have given some kind of a relaxation. They said in case of normal cases, if we pay the interest and the tax demand before even issuing the show cause notice, no penalty would be levied. But there is an exclusion on this, that in case there is a short payment or non-payment of tax of which was already collected by the assessee from the consumers or the customers, or if there is a short payment or non-payment towards self-assessed tax, which you yourself declared I am liable to pay X, but I paid X minus, then the penalty provision is not waived off. In case the show cause notice has been issued, then within 60 days of issue of the show cause notice, if the tax demand is paid with interest, penalty would be waived subject to this condition which I have spoken about. In case of fraud cases, of course, they have said that there is a certain percentage of penalty which has to be paid, 15% before the issue of show cause notice, 25% if the show cause notice has been issued but the order has not been issued, and if the order has been issued, then 50% of the penalty. The catch here is, while they have given a provision to waive of the penalty, the prosecution provisions in terms of imprisonment are not waived off. So that is an important thing which one must continue, and those provisions continue as they are, depending on the threshold of tax evaded because of fraud reasons. The imprisonment ranges for 1 year or 3 years or 5 years. Next slide, please. Then there are procedural changes, and I'll just quickly take you through them. One is that you remember that secondment issue which came up 2 years back by the Supreme Court decision on Northern Operating System. So that all those cases were somehow ambiguous in the provisions of law. Now these guys have said that the time of supply with respect to any supply of services received from an unregistered supplier will be the earlier of either making a payment to that supplier or the date of issuance of the self-invoice by the recipient. Earlier, this provision was missing. It only talked about the cases of raising a self-invoice which are covered under section 9.3 or 9.4 of the Act, which related to registered suppliers only. Now, this squarely covers the overseas suppliers who would not be registered under the Indian GST system. Any supply received from them, the time of supply is now there is no ambiguity in it, which means if I make the payment to my foreign company today, but I don't raise the self invoice and I don't deposit the tax on RCM, the interest liability continues till the time I pay the taxes, and the penalty for not raising a self invoice also continues till that date. That's a huge change which we have to be very careful about. The second thing, good thing which they have done is the tax paid because of section 73 proceedings, non-fraud cases. They were earlier allowed, but any tax paid by virtue of fraud proceeding, they were disallowed under section 17 subsection 5. Now the government has said all those taxes paid by virtue of the new amalgamated proceedings, fraud cases or non-fraud cases, would be allowed to you as a tax refund. So to that extent, there is a savings. The deposit thresholds for pre-appeals, they have been reduced drastically. Earlier it was 50 crore before the commissioner appeals, reduced to 40 crore now. If it is a state CGST, SGST, then it is 2020 now. And in case of tribunal, which used to be 100 crore, has been reduced to 40 crore. Next slide, please. In terms of retrospective amendments, they have come out. This is more of a procedural clarity that any ITC up to 31st March 2021 can be claimed in any return filed under section 39, which is the monthly return, GSTR 3B or composition return. It can be claimed till November of 2021. Now those dates are already passed, but if anybody has claimed these, the ITC claim has now been regularized. They have also come out with a clarification where the registration of a taxpayer is cancelled but subsequently revoked. Then how do you deal with the ITC claim during this period? They have come out with conditions on that. In terms of the exclusions from GST, they have added one clause. Earlier, the alcohol for human consumption, which is the liquor which we'll probably have in the evening today, that was taken out, which was out of the purview of GST. Now they have said this undenatured extra natural alcohol, which is an essential ingredient for making that liquor, that will also be taken out of the levy provision, so not subjected to GST. And then they have regularized certain anomalies in the co-insurance and reinsurance part, so that they have put under Schedule 3 as these kind of activities would not be considered as a supply, settling the past disputes and rationalizing the activities of insurance companies. Next slide, please. Then the important one I will tell you is this summons one. Earlier, when a summon was issued, the person to whom the summon was issued had to appear in person. Now they have given the leeway that an authorized representative can also appear on that person. It's a big relief. And then there are certain procedural ones, that is, penalties for e-commerce operators would only be applicable on those who are liable to collect tax under section 51 of the GST Act, and not to all e-commerce operator. And then there are again procedural empowering provisions which the government has taken upon itself. The important one is that based on general practice, which is the practice of the trade and industry and not applicable to a particular sector, anything, any kind of a non-payment or a short payment which has been happening, the government has now the power through the GST Council to regularize it and waive it off completely. Next slide, please. In terms of customs, there are quite a bit of tweaking of rates to promote the domestic manufacturing or to promote healthcare. So various duties have been reduced, including cancer drugs, medical equipments, mobile phones have been given impetus. The important change in customs I would just talk about is specifically in case of MRO sector, aircraft and vessels. There the period was earlier 6 months. That has been extended to 1 year, which can be further extended by another 1 year. Now, what happens is if the foreign aircrafts or vessels are brought into India for the purposes of repair, overhaul, maintenance, they had to be sent out of India within 6 months. Now, this period has been enhanced. It's a big relaxation to the MRO sector. And similarly, in terms of goods exported for any particular purpose other than those under export promotion schemes, they have to be brought back into India within 5 years, which was earlier a 3-year period. These provisions would apply immediately from yesterday itself. And then there is again a rationalization. The new trade agreements which are being entered into between the countries, they provide for a self-certification to prove a certificate of origin rather than getting a certificate of origin from the government authorities. So there is a rationalization to permit those kind of things in the Customs Act also. Mover scheme was a very popular scheme, but the government has now taken on the power that they can specify activities which will not be considered as manufacturing part of the mover scheme to avail of those benefits. And then there are extension of certain exemptions and a sunset clause on certain exemptions hitherto before given for customs duty. And a retrospective event from July 1, 2017 has been given to SEZ units from a charging GST compensation cess. So this would be a retrospective effect, effective from the date when GST came into picture. These are the broad contours in terms of indirect taxes, and happy to take your question later. I would now like to pass it on the baton to my partner Vinay for the policy decisions. Over to you, sir.
Thank you, Sandeep. We have exactly 5 minutes left, and we have about 7 slides to cover. So I'll just touch upon all those key policy changes and matters that are there. Moving on. I think there's always this debate about the unemployment and the employment generated in the last so many years and so on. Again, I think this budget, the government has given the impetus to employment and skilling as one of their main priorities, the 9 priorities that the government has already highlighted in the interim budget. So moving on to the first priority, that is employment, they've come up with 3 schemes, scheme A, B, and C. A is for first-timers. First-timers, the government says that the 1 month's salary is going to be paid. The direct benefit transfer happens in 3 installments, and the salary limit is going to be 1 lakh. Scheme B is for the creation of jobs in manufacturing sectors. This incentive is going to be given to both the employee and the employers for the EPFO contributions done. Again, the amounts are not specified here. It's going to be based on specified scales. Scheme C is the support to the employers alone. So any additional employment that is generated across sectors, the government is going to reimburse the EPFO contributions with a cap of rupees 3,000 per month for 2 years. So if you actually look into the minute details, it may appear so that there is an overlap between some of the schemes, and there's also this 80 JJA in the tax where you get deduction for the additional workman compensation and so on. So I think we need to wait for the clarity in respect to these schemes, and this is with respect to the employment. Moving on to the next slide. Skilling. Yeah. So again, skilling has been one of the most important aspects here. If you look at the first one, that is 2 million youth will be skilled over the next 5 years. There is also a model skill loan, which has been revised now from the earlier limit to 7,50,000 rupees. And about 25,000 students are going to be benefited out of this. The third one is on the financial support for youth who are not covered under any other benefits or the policies. There's going to be this financial support for loans for their higher education in the domestic institutions, which is going to again benefit about 1 lakh students. And moving on to the fourth one, there are about 1,000 ITIs, basically the industrial training institutes, which will be upgraded in a hub and spoke model. And moving to the last one, about 1 crore internship opportunities at top 500 companies. Again, there has been a lot of discussion and debate on this particular aspect as to how many internship opportunities have been given in the past. And are these numbers really realistic? I mean, are they achievable, or it's a challenging number? That is number one. And what the policy also says is that for the internship that is offered, the company is going to bear the cost of the internship, while the government is going to provide an internship allowance for a period of 1 year. And the companies can also claim 10% of the internship cost from their CSR fund obligation, from the CSR obligation, basically. So this is on the skilling. Moving on to the next slide, that is on manufacturing and services. And all of us know that, I mean, the government has been very particular about the kind of attention that the MSME sector gets. So this entire slide is dedicated to the MSME sector. The credit guarantee scheme. So this is basically to support companies who are in the manufacturing sector for their procurement of plant and machinery and equipments without any collaterals or third-party guarantee. So that is what the government is proposing. There is also a new proposal for the assessment model for MSME credit. So all the public sector banks are actually required to build capabilities to develop a credit assessment model. They have to do away with the old traditional method of looking at the turnover and the asset base and so on. So it will be more on credit rating model is going to be developed based on the digital footprint, And also, this is, I think, definitely this is going to take some time, but yeah, this is something that is really new. The third one is on the TREDS, that is the Trade Receivables Electronic Discounting System. So there are companies, corporates, public sector undertakings, and governments who are actually buyers in these in the system, basically the electronic discounting system. So there used to be a threshold for 500 crores for companies who can be eligible to be onboarded here in the TREDS, but now this has been reduced to 250 crores, which means the MSMEs, it's going to be easy for the MSMEs to actually manage their working capital. They can liquidate their receivables at a faster pace. That is number 3. Fourth is credit support to MSMEs during their stress period. So basically, this special mention account stage MSMEs, which are moved to these SMA accounts due to various reasons beyond their control, the government proposes to continue to give credit until so that they don't reach the NPA stage. And this is also going to be guaranteed by the government through an approved fund. This is number 4. Last in this slide is on the Mudra loans. The limit for the Mudra loans has been increased from 10 lakhs to 20 lakhs. This is only for those MSMEs who have already successfully repaid their earlier loans. Moving on to the next slide. The government is also proposing to develop plug-and-play industrial parks in about 100 cities across the country. There is also a proposal to add 12 industrial parks under the National Industrial Corridor Scheme. The third one is an integrated tech platform for the IBC ecosystem. So what exactly is the objective of this ecosystem is to actually enable companies to function in a more transparent and a consistent manner, and also for all the stakeholders to have a clear understanding as to what is happening in this IBC process. That is the expectation. And similar to what we have, the CPACE, that is called the Center for Processing Accelerated Corporate Exit, which we have for the corporates. A similar proposal is also there, which they want to extend it for the LLPs for a quick voluntary closure of all the LLPs. And the last one is on the strengthening of the tribunal and appellate tribunals. The number of tribunals are proposed to be increased, and also to increase and relook at the way the administration of these existing tribunals are functioning. That is on the last slide on the tribunals. Moving on to the next slide. Yeah, talking about the next gen reforms, the UL PIN or the Bhu Aadhaar is nothing but the Aadhaar for the lands. So the government is proposing, I mean, though this was actually implemented for about 10 states in about 2021, this is now going to be implemented across India. So basically, the plan of the government is to completely digitize the land and give unique identity numbers, and also digitize the maps, so that basically the elimination of the land disputes, and also to facilitate the credit flows to the, let's say it could be the farmers or the landowners and so on, is easily tracked. So these are some of the new gen reforms. Similarly, the land records in the urban areas also are proposed to be digitized with the GIS mapping. This is on the new gen reforms. Moving on to the next slide. On the infrastructure, again, there has been a significant impetus. The central government has proposed 11.11 crores of rupees for capex in the coming years, which amounts to about 3.4% of the GDP. And the central government also encourages the states to provide a similar support, for which the central government is proposing to earmark about 1.5 lakh crore rupees as a long-term interest-free loan for the states. Similarly, there's been a lot of emphasis on the tourism, especially on Bihar and Odisha with the various temple corridors, and also the Purvodaya, which is also one of the policies that the government has come up with to improve all the eastern states, that is Bihar, Jharkhand, West Bengal, Odisha, and Andhra. And lastly, the Prime Minister Gram Sadak Yojana, which is in its phase 4, the government is proposing to connect 25,000 rural habitations through this particular scheme. Okay, moving on. Yeah, I think I've taken exactly 7 minutes. And with this, I think we can move on to the Q&A session. Manisha, over to you.
Thank you, Vinay. Now we are in the most exciting session of part of the webinar where we are taking up some quick questions from our lovely speakers. So my first question is to you, Rajiv, since you have opened the floor and opened the webinar and the discussions. So my first question is to you, and I would like to know that there is a question from the audience that how do you see the foreign investors' confidence building up in India?
Interesting question. This can be divided into multiple sections. See, the government, have been talking about attracting foreign investment, uh, both in the Modi 1 as well as the Modi 2.0. And if you go back and see the 10 years there, and I would also give this to the prior governments, that they've kind of made steady progress in making things attractive for the foreign investors to come in. The the most important factor has been, the emphasis on infrastructure growth. I think while that is a continuous factor, even in this budget, I think, and in the last presentation, it got covered that a humongous focus is still on infrastructure development, whether in terms of industrial corridors, whether in terms of, roads, power. There is a huge emphasis on all these sectors. If one was to read between the lines as to what the government's intention is, it's clearly the focus on investment. And when I say investment, I would say foreign investment is obviously a very large part of this focus. Not that the domestic investment is not equally important for a country like us, where we need growth, employment. I mean, we are saying that we want to be the third largest economy in the globe, then that cannot happen with just domestic investment. The foreign investment is equally to be involved. I would like to add one more point here is that India's focus on growth also comes from the foreign investors' point of view, is on the service industry. The service industry has been a very large contributor. So a lot of emphasis and ease of doing business that has been done, whether it is cutting down the foreign rates on foreign companies, tax, whether it is the what Sunil mentioned about the GCCs and the again safe harbor rules, probably that is one of the things that they said, and a number of irritants that the system has cleaned up, whether it's angel tax or whether it is other issues, equalization levy. So if one was to all in all bring them together and analyze, the underlying tone of the government is very clear that they want to simplify the issues, number one. Number two, they want to clearly look towards ease of doing business. And number three, they want to provide the infrastructure for investors, foreign investors, to come and do business in India. So all in all, I don't see any reason why this will not bring in more investment from the FDI perspective.
Thank you, Rajiv. So now, after hearing your thoughts on the investment side, foreign investment side, we are very sure that we would be getting a more investments from the foreign companies. And as you mentioned, as you said very correctly, that the government's focus is to simplify the compliances and the regulatory systems and on.
Sure.
So moving on to Sunil, that we have one question from the audience, that what happened to the proposal to move to direct tax code?
I think that's a good one. I think what direct tax code, I think, has been a long forgotten story until I think 2019, when a special task force was set up under the Modi government, Modi 1.0, towards the end of Modi 1.0. And I think some findings were there. But essentially, if you see what's happening today, we are talking about the new regime and the old regime. These are all part and parcel of the direct tax code only. So direct tax code very clearly said we want to do away with all the exemptions and deductions, and this is what is effectively happening now. So I think in effect, we are going to find a similar shape and structure of the direct tax code, whether we call it the direct tax code or not. But as I said in my presentation, we are going to relook at the entire income tax act as a whole. And I believe the direction will be the same. So whether we call it the direct tax code or not, I think the findings and the shape of the structure of the new law is going to be the same. I think we are moving in that direction.
That's nice, Sunil. So, continuing with this, we have another question for you as well. Again, is any TCS shall be liable on sale of any fixed assets, example, machinery exceeding rupees 10 lakhs by any company?
I don't think so. I think the intent was very clear that they only wanted tax collection at source on luxury items, and the list of the luxury items is yet to be notified. I'm assuming these will be watches, expensive bags, and other items of personal effects. I don't think machinery will be covered here.
Okay. So, Sandeep, now we have one question for you as well, that and would be the interesting one for the audience. That will the government bring alcohol for human consumption and petrol and aviation fuel within GST regime now? Where the budget proposals are more on policy matters, bring clarity and reduce litigation. What's your thought on that?
See, while aviation and turbine fuel could be the first one to come in, the regular petrol and diesel which we use in our everyday lives, as well as the alcohol, I think these are very heavy revenue generators for the states. Now, GST being a destination based tax, a consumption based tax, looking at Chennai, which is very heavy into manufacturing, Tamil Nadu is a very heavy manufacturing state, would probably not like to lose out on this revenue also. Time will tell. I mean, it's all the states have to agree to it first and foremost, because GST Council is a composition of representation from all the states. All the state finance ministers are part of the council, so they all have to agree. And once they all come on board, then yes, it can become a possibility. But I don't see that happening in any time in the near future. Aviation and turbine fuel could be the one.
Great. So now again, question is for you, Sunil, that could you please elaborate more on transfer pricing, safe harbor rule in IT/ITS sector, vice versa APA?
I think I did mention in my talk that the range of the safe harbor really falls between 17 to 24%. And 17 is really 17 and 18. The rate applies to really IT, software development, IT and ITES segment. Now, what is given in the safe harbor and what is generally agreed in the APAs, again, one would go for an APA only when the volumes justify. When the volumes are humongous, they're large, and the intent generally is to get into a bilateral arrangement, not a unilateral arrangement. So I think from what we have seen from our experience, the 18 has been brought down to somewhere close to 16, 16.25, 16 and a half. Again, depends on negotiations. I haven't seen something going below 16, but that has been the change. But please remember that in this industry, this is a cost-based industry. This is a cost-factored industry because you're trying to capture the arbitrage. A 1 or a 2% difference can make a huge, huge, huge deal. It's a big deal. So that's what APAs have achieved for transfer pricing.
So I have one more question for you, Sandeep. What impact will the change in customs, wherein imports have to prove that the rules of origin apply to claim preferential rate of custom duty on importers? Will this increase litigation in customs?
See, here the provisions of the relevant trade agreement will have to be studied very carefully. Whatever are the conditions laid down in that trade agreement will need to be fulfilled. Now, if that talks about the specific particulars and description and ultimate origin of the goods which are being imported into India, they have a bearing on the issue of certificate of origin by the country from where it is being imported, then yes, litigation will surely arise. The idea is the idea for having this kind of a thing into place is, number one, not to bombard cheap goods into our country, which can completely throttle our domestic manufacturing, our local industry, and which is like anti-dumping kind of a thing. And second is to to probably not encourage imports from certain geographies. Now, those could be political considerations, those could be economical considerations, or whatever. But yes, with the current changes, I think litigation possibilities should certainly ease out a bit, because they are only relaxations which are coming in. But let's see what happens.
So as we have already spilled over for 15 minutes, so I am just having one last open house for this, that how is this budget impact gold rate in India? Please brief the economics behind it and the mindset of India as a market for gold.
So when you say open house, answer it, right?
I can only add one dimension here, that they've tried to cut down the duties on gold. That is one thing to bring the prices down, and of course to avoid some kind of smuggling that was done. So they've done well, but gold is a very internationally, it's traded internationally. So the prices of gold doesn't get determined by anything that is India has to do. India is, of course, a big consumption market. From that point of view, there will be an impact, but otherwise, I don't see how much this budget really has any impact on the overall gold prices in India because of consumption. That's my view to the whole thing.
See, I'll add on to this. If you look at the budget, the increase in STT provisions clearly, discouraging FNO contracts, because a lot of money was going, and almost everybody to the lowest level start of the society is indulging in FNO trades. I think the same way, the savings going into bank fixed deposits, the savings going into gold, they were reducing, because most of the savings are being diverted to the stock markets in India. I think this is just another small attempt to, diversify the savings and not put all our eggs in one basket only. I think this also has a bearing on reduction of import duties.
All right. So thank you all for sharing your insights through this session. I would also like to thank our audience for joining us today. We'll be sending you a recording of this session in a couple of days, as there are some more questions that we could not take due to a shortage of time. We will reply to every question individually over email. If anyone has any further question, please do not hesitate to contact us or to write on manisha.sachdeva@asa.in. Thank you all. Thank you so much, Sunil, Rajiv, Vinay, Sandeep. Thank you so much for this engaging session. Thank you all.
Thank you all. Bye.